Hey everyone! Welcome back to our channel. If you're new here, don't forget to hit that subscribe button and join our community of savvy investors. Today, we're diving into a fundamental concept that every investor should know, the price-to-earnings ratio, or PE ratio. So, grab your favorite snack and let's get started. Now, have you ever wondered how investors determine if a stock is a good buy or if it's overpriced? One of the key metrics they use is the PE ratio. But what exactly does it mean, and how can it help you make better investment decisions? Let's break it down. To start, the price-to-earnings ratio is a simple formula. It's calculated by dividing a company's current share price by its earnings per share, or EPS. So, the formula looks like this: PE ratio equals price per share earnings per share. Let's say, for example, that company ABC has a share price of $100 and its earnings per share is $5. Plug those numbers into our formula. PE ratio equals 105 is equal to 20. This means that investors are willing to pay $20 for every $1 of earnings that company ABC generates. But what does this number really tell us? Generally, a higher PE ratio suggests that investors expect higher future growth from the company compared to companies with lower PE ratios. However, it's important to note that a high PE ratio doesn't always mean a company is a good investment. It could also indicate that the stock is overvalued. On the flip side, a lower PE ratio might suggest that the stock is undervalued, but it could also indicate potential issues within the company. So, context is key. Let's take a look at some real-world examples to illustrate this point. Consider two well-known companies, Apple and Ford. As of last year, Apple had a PE ratio of around 28, while Ford's was approximately 12. What does this mean? Well, investors might be willing to pay a premium for Apple shares because they expect continued growth and innovation. Ford, on the other hand, has a lower PE ratio, which might suggest that investors are less optimistic about its future earnings or that it's a value stock worth considering. Now, it's crucial to compare PE ratios within the same industry. For instance, a tech company might typically have a higher PE ratio than a utility company due to different growth expectations. So, when you're analyzing a company, make sure to compare its PE ratio to its industry peers. This will give you a clearer picture of whether the stock is fairly valued. Another important aspect is understanding the difference between trailing PE and forward PE. Trailing PE, this looks at earnings from the past 12 months. It's based on actual results and can provide a solid foundation for assessment. Forward PE, this is based on projected earnings for the next 12 months. It allows investors to consider future growth but comes with the inherent risk of relying on estimates. For example, if company XYZ has a trailing PE of 15 but a forward PE of 20, it might suggest that while the company has performed well historically, the market anticipates a decline in earnings in the near future. Now, let's talk about some limitations of the PE ratio. One significant downside is that it doesn't account for growth rates. A company with a high PE ratio might be justified if it has a high growth rate. Conversely, a low PE ratio might not reflect the potential of a company with a strong growth trajectory. Additionally, PE ratios can be influenced by external factors like market sentiment, economic conditions, or even temporary spikes in earnings. So, it's essential to conduct thorough research and consider other metrics, like the price-to-book ratio or return on equity, to get a more comprehensive view of a company's health. In summary, the price-to-earnings ratio is a valuable tool for investors, helping you gauge whether a stock is overvalued, undervalued, or fairly priced. By understanding how to calculate it and the context in which it should be used, you can make more informed decisions about your investments. If you found this video helpful, please give us a thumbs up and share it with your friends who might be interested in investing. And leave us a comment below with your thoughts on PE ratios or any topics you'd like us to cover next. Thanks for watching, and until next time, happy investing!